Securities, where we don't just secure investments, we secure your future. Finance is constant. The need for a reliable partner. At Yes Securities, we are not just wealth managers. We are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls. We build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors. Because your success is our business. Yes, Securities, empowering tomorrow. Welcome to Yes Securities. In the ever changing landscape of finance, one thing remains constant: the need for a reliable partner. At Yes Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls. We build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors. Because your success is our business. Yes, Securities, empowering tomorrow.
Hello everyone. Welcome to Yes Pulse, our new webinar series focused on technical and broader aspects of finance. At Yes Securities, our mission is to make finance empowering and accessible to all, regardless of their background or experience. Over the past decade, we have transformed from transactional broker to a trusted advisor for both retail and institutional clients. Reflecting on our last session earlier this month, we explored the topic trading on trend following methods and moving averages. I hope you found it as insightful as I did. I'm delighted to introduce our esteemed speaker today, Mr. Ravindra Bhandari, who brings over 15 years of experience in Indian financial sector. With expertise in investment banking and corporate investor relations, Ravindra's insights are profound and practical. Armed with an MBA in finance along with prestigious certifications such as CFA and FRM, Ravinder's knowledge is invaluable. Today he joins us to discuss decoding investment in a high growth environment. And guess what? If you miss any of our sessions or want to revisit the valuable insights shared, don't worry. We'll be uploading the entire series to YouTube under playlist name Yes Pulse, so you can catch up at your convenience. We also want to hear from you. After presentation, ask questions and share your thoughts in comment section. Your engagement makes this series remarkable. Also, like always, we have exciting polls coming. Over to you, Ravindra.
Hello, good afternoon, everyone. Thanks for sparing time for today's discussion. As mentioned, I would be discussing about uh, how to manage high growth environment and what kind of assumption and aspiration you have from the capital market during those times, and how to decode investment in a growth environment. First, I would like to tell you that why growth is very important for equity investing. Say, equity investing comes with a high amount of risk appetite and risk capital, and that risk capital flows or gravitate towards the jurisdiction or sector of the economy which is expected to experience high growth phase. Generally what happens that if the growth rate has stagnant, then the equity performance will be a bit dull. But if the sector within the economy or the economy in general is expected to experience very high growth rate, then the equity performance in that economy will be very strong. And the global fund also get attracted towards that high growth phase. Say what we experience in case of China. China experienced about 8 to 10% growth, the real growth, for at least two decade, 25 years period of time, from late 90s till early 2020. And in during these times, what happened that the global fund was chasing China. Now, India also stand at the same jurisdiction where China was about 20 years back. We are also about 2,000, $2,500 per capita economy. We are also growing at 6.5, 7%. This is stat lower than China, but this is again the fastest growing among the major economy. And hence this is due to attract huge amount of global capital. Maybe the thought coming in your mind that for last 2 years there has been a redemption of FIIs in India. But if India continues to grow at the 6.5, 7%, we are destined to attract huge amount of capital from global investors. While talking about this huge growth phase, there are few peculiar aspect of high growth feature economy I would like to talk about in today's discussion. One thing which we as an analyst or as an investor always think about is how you are forecasting growth or how you are modeling growth in your assumption. The trick here is human mind is structured to think more linearly than exponentially. Why I'm saying this is it is very easy for me to convince a fellow investor that okay, this is the company, this is expected to grow at 10 12% along with the economy, and this used to grow be traded at 15 p multiple and now trading at 10, and hence an ideal investment. This is a easy saleable idea compared to something like this is the huge kind of disruption which will happen in the country, and within that disruption this is one idea which is going to experience a exponential growth. Because whenever you're talking about exponential growth, there is huge amount of uncertainty. The risk factor also comes along with it. While our mind is more inclined to think more linearly, especially in investment world, because anyways the equity investing is very risky. It takes an effort to think about the exponential growth which can happen in the country, so identify the ideas which can grow exponentially. So we would be talking about different aspect of that growth in today's discussion. Something which how to value a very high growth would be entirely different than what you value or how you decode your investment in a normal scenario. Say in a normal scenario, if the most commonly used valuation metrics is PE multiple. When you are comparing two companies which are experiencing different stages of growth, PE multiple itself, even if you are taking a far out time period, will not be enough. Suppose, say you are experiencing a mature company in a FMCG sector, you can say that they are trading at a 40 PE multiple. But there can be a startup or something which is growing very exponentially, where the revenue is doubling every 2 3 years. They're taking a P multiple itself will not be enough. The reason is the growth would be so exponential in next 3 4 years that the entire paradigm of the company, the entire value proposition of that company will change. In those scenario, rather than taking that plain vanilla PE multiple, what investor used to look at is a PEG, what we call as a PEG multiple. How this is relevant is Say a company is growing at 30% annually for few years, is expected to grow at 30%, and the price earning multiple is also available at something about 30 times. Then we say that the PE divided by the growth rate, the 30 is the PE multiple and the growth rate is 30%. So the company is trading at a PEG ratio of 1x. Compare it to the another company which might be growing at 15% annually, but they are trading at say 20 times forward earning. So here what happens, despite the company is trading at a 20 p multiple compared to the 30 p multiple of a high growth phase company, the peg ratio is identified at 20 divided by 15, 1.33. So this comes as more expensive because uh, if we capture the growth potential of the first company, they are trading at cheap. So that is one way how we balance two different company which are growing at a two different pace in the investment world. The other thing which investor always look at is identify the time period for which the company will grow exponentially. Say if we are modeling or forecasting for a 10-year period, you may forecast that for the next 5 years the company will grow at 25% plus, which will be exponential period. And after that 5 year period, the company growth phase will come down to normal phase where it will be grow at 10-12%. So what individual or an investor do is dissect the growth phase of the companies into two part. The first part would be that high growth phase where the company would be growing exponentially. The second part would be where the company growth will linearly migrate towards the normal growth rate, and hence we will identify what kind of wealth creation across that time period. If we are taking a 10-year time period, what kind of wealth creation or profit generation this company will experience for a longer time frame once during the time through this exponential growth phase, and after this exponential growth phase how much the company is growing, and compare it with some other sectors, some other companies which is not growing at exponential phase, that how much those companies will deliver in terms of profitability in next 10 years, and how those is the quantum of profit is tagged against this company where we are looking, which is undergoing that high growth phase. Another thing which is very important when we are experiencing companies in a high growth phase is there is too much number of factors moving parts around, and hence it becomes more difficult to identify the winner when there's too much disruption which is happening. Say today world, we can say that very easily 20-25 years back, Google was clear a disruption in the market, and it was a destined to be a winner play if any investors have picked Google 20-25 years back. But if we move back that time period 20-25 years back, Google itself didn't know its own total potential at the beginning of the phase. For a very long period of time, the search was more towards Yahoo, and it was very difficult to identify which eventual company would be the winner in this sector. So whenever a sector or a cluster of companies are experiencing very high growth phase, there will be too many moving parts around, and it will be difficult to identify at that juncture which would be the sure shot winner. Generally what happens is you start with a small thesis, and then you build your thesis as the time goes along. As the time moves forward, you incorporate new data, new set of information which flows towards you, and see how your investment thesis is performing. Though you might say that the Google and the Yahoo examples are 2 decades old and it is not very relevant, but think about say last 2-3 years what we have experienced in the Indian market. Today you will see all media house come along and says that Zomato was such a easy pick 2-3 years back. Everyone was using Zomato. Everyone is using multiple times in a week Zomato or quick commerce, big basket, or any other services, and hence it was such a easy pick to identify that they were available at decent valuation. But believe me, If I rewind, if I go back 3 years back, there were decent number of new age companies which were trying to gain market share, not market share, the mind share of investors. Now we are not talking about many of them. The Paytm, the delivery, when it was launched, they were equally a great disruptor in their own sector. But eventually there is some regulatory pressure which has happened and something has happened in those sectors. What the thing I'm trying to convey is, whenever the disruption is happening and the sector is undergoing a very high growth phase, at the time of that churn, it will be very difficult to identify which will be the sure shot winner. You build your investment thesis, you build your investment case, and then you keep on revisiting your investment thesis after every month or every quarter, and see what kind of changes you need to incorporate in your thought process. Because at the time when the disruption is undergoing itself, it will be difficult to identify what kind of business model will succeed in the long term, because that is a process in the making. What I'm trying to say is, whenever you will experience any sector which will be going through a very high growth phase, there will be a lot of moving parts, and hence it is rather being flexible in your approach would be more prudent than sticking to one investment idea and sticking to it. Because what will happen there, because the company which is itself is disrupting, it might get disrupted from someone within the sector or outside. Hence, if you are keeping your idea flexible, it will be easier for you to incorporate new information. Otherwise, what will happen is, whenever new information will come to you, you will be stuck with your old ideas, and you will not be able to move around with your new idea. uh, Other thing, as I was saying, is human mind is structured more to think linearly. As I was saying that, if I give you an idea that, okay, this company is expected to grow at slightly stronger pace compared to the Indian economy, it is easy to understand and visualize that idea. But bringing an idea which would be something disruptive, it will be very difficult, because having a clear vision when there are lots of moving parts to a story, and how much credence or weight you need to provide to a single factor of that company or that sector would be difficult when the company itself is unfolding its high growth trajectory. So whenever we experience, say, your first thing is you identify the company, whether that company is in that high growth zone right now, or it is growing at that linearly phase. If it's in a high growth zone, then you try to figure out what kind of risk, be it within the sector or outside sector, which may come and impact the growth story. Other thing which we do is, if you are forecasting something which is too out in terms of time period, or there are too much of moving parts around, you discount your growth rate. Say, if you are forecasting or seeing the industry forecast which is expected to be 25-30%, but because there are so many moving parts in that growth story, you will discount it by, say, 20-30%, and then you will say that, okay, my understanding is with certainty it will grow at 20-22%. So rather than having that something which can grow at 30-35%, you add a certainty factor to it, so that you moderate that growth rate, and that is actually what can easily be achieved over a period of time. So you add some certainty factor there, in terms of identifying what can be the growth engine. Other thing is, as we discussed, that equity always attracts where the high growth is there. It's a kind of equity, for equity growth engine is kind of gravity. Uh, the higher the capital will flow towards the jurisdiction which is experiencing high growth, and within that high growth, what other things which is very relevant is how that high growth is achieved. Something whether the industry inherent is poised for a higher growth, or this growth is pushed with some other external factor. Something like, whenever the high growth is pushed, is it at the sacrifice of margin or not? Is it at the cost of imprudent practice in terms of working capital or not? These are important feature, because ultimately, whenever the competition will come up, or the sector will get saturated, the player will resort to normalizing. If they are giving heavier discount in the earlier phase to achieve higher growth, they will move out of that higher discount, and will look for normalized profitability. Something working capital which is very important is, uh, whether if your product is not easily, if any company's product is not easily sellable in the market, what they do is they provide easy funding limit, easy funding requirement for their customer, a lenient payment terms to the customer, which help them to say pre-purchase some of the items from the companies. And in that scenario, what you will see is, though the sales are growing, but the working capital is also getting stretched, and ultimately it reflects in your return ratios. So overall, as a financial investor, we always look at what is the return ratios for the company. But dissecting that return ratio, you can identify whether the return ratios is lower because you are giving away too much of discount right now in terms of operating margin, or you are too lenient in your working capital so that the sales are achieved. If that is happening, what will happen? If you are too lenient on your working capital, then your balance sheet will be bloated and your return ratios would be lower. So those kind of things also you keep in your mind when you are experiencing a company in a high growth sector. And other thing is, you always, as Charlie Munger always used to say, you invert whatever thought process you are having. So if you are thinking about high growth rate, say for example auto market, if say for last 2 3 years, after 7 8 years time period, for last 2 years we are experiencing a decent growth in the auto market. So how you dissect this growth? First thing is, say if I talk about the two wheeler market in India, how first thing is to identify what could be the total addressable market for two wheeler in India. For that, how you identify? You again dissect it further. Say you will say that 140 crore people around, and addressable market, the age bracket for a ideal two wheeler would be, say, something about 20 to 65. So that population, that pot is about 70 75 crore. Then you see countries which are similar to India. So similar to India will not be the Western countries, because there is more prevalence of four wheeler. But something like Thailand, Indonesia, where the activity is more on two wheeler side. So what is the propensity of consumption or consumption intensity in those countries? So there you will find that per thousand people, the number of vehicle the holding is about 300 350. In India, it would be about, from the addressable market, it should be about 150 170. So you, from there you understand, there is, as the affordability within the citizen improves, there is high chances of we also experience and reach that kind of penetration as the Southeast Asian country. Then you think about, say, a different product. If we are talking about four wheeler, the thought process will move from, rather than direct penetration, how much is the affordable penetration? Say right now India would be about 40 45 per thousand people, the vehicle penetration. Western world is about 700 800. The Southeast Asian country would be about 100 plus. So as here there is no question of that if you make the vehicle available for sale very soon, it will be absorbed. There you have to understand what is the affordability for the Indian diaspora, and as the affordability improves, then the consumption will improve. So those are different moving parts for dissecting growth. And I'll reiterate the point that why growth is so important for equity investing is, say you do equity investing to beat inflation. So how this is important is, say Indian economy is expected to experience 5 to 6% inflation. So to beat that, you need to achieve, say, 6 7% kind of real growth, so that your equity investment perform at least 13-14%. Over a 10-year time period, I guess equity performance is about 14%. If we include dividend, it would be 15%. So if you move your capital towards the sector which are experiencing at a high growth phase, and they are available at a decent valuation compared to their historical benchmark, then you will be able to achieve that 14-15% return, which will be good enough to beat the inflation and the benchmark. uh, Other thing about growth is, say now I'm talking a bit different view. Why growth is so important? Say, for a country like India, if we grow below 5%, then there is huge chances of social unrest. Given our per capita GDP and the kind of literacy, the kind of poverty we have, we need to grow at that 6.5-7%, so that we can take care of our citizen. Uh, Growing at 4 and 4.5% creates a vacuum in terms of not meeting country's aspiration. There was one very terrific study done about growth rate in India, which was talking about, say, right now we are about $2,500 per capita income. Say China was at this stage about 25 years back, and China is about now, I'm not very sure, but something about 13,000, $15,000 per capita. What we are saying is right now our median age is about 27, 28 years old. So there is a saying that India should grow richer before it grows older. So that the aspiration what a 30-year-old person bring in terms of having a better earning and a better lifestyle would be completely different than what a 50-year-old guy will bring in. So our ideal requirement at this stage is, now I'm talking more about, less about the equity investing, but more about different angle. But India should become richer, which is about $10,000 per capita, before it hits that 45 years median age, because then the aspiration of the median age becomes different. They want the quality of life as a better, rather than having more economic meaning, adding more economic meaning to the life. But coming back to our core topic, why decoding that growth? There are few ways how we can decode. One is, if we are evaluating different sector, or the different companies which are experiencing different stages of growth, you identify the peg ratio. Okay, what we have done is, we have put in some kind of poll also. So let's see if you are paying attention to what we were discussing. So there is first question which is live here. So how you calculate a peg ratio? We'll wait for 30 seconds for people to answer on this. Guys, if you are there, please submit. You're receiving answers.
Yes, 100%.
Okay, okay. Uh, so the answer is definitely uh, the peg ratio is important, and how it should be calculated is P divided by the growth rate. The second question is, how do investor use two growth phase? Uh, which would be the ideal? Uh, where there would be ideal scenario to do a two growth phase model, whether it should be used when the growth is very stable, or during the time when the growth uh, is different. I guess we got 67% answer in the second one. uh, the correct answer was, whenever you are experiencing two stage model, that the first stage the growth rate is very high, and the second stage the growth is lower or normal, then you move towards a two stage model. And yeah, this thing is very important. How do we use extrapolation of the current growth phase. The thing is, as an equity investor and analyst, what we do is we experience, say, a high growth phase for a small period of time, be it 1 year, 2 year. Then we try to extrapolate that same growth rate for a very long period of time, which I believe would not be ideal. The reason is the scenario will change as any industry grow at a very high pace, it will attract competition, and that itself will kill the high growth feature of that sector. So it would be imprudent from our part as an analyst and investor to extrapolate any kind of high growth phase for a very long period of time. In that scenario, it would be ideal to use that again, that stage model, where you forecast for a time period, be it 3 years, 5 years, when the company will experience that high growth phase, and then the growth will subside to the normal growth rate. Those were the questions. In case you guys have any question, you can put it on the chat box. uh, we'll wait for some time if in case you have any question. Guys, if you have any question, you can put it on chat box. Otherwise, we have discussed pretty much what we are planning to. uh, if you have any question, you can put on the chat box. I don't think there is any further questions, so uh, we can end the discussion here. Thanks everyone. Thanks for joining for this discussion. Hope you find the discussion interesting, and we'll come up with another topic. Maybe I guess on 12th of June we are planning the next webinar. So stay tuned, and we'll come up with a different topic on 12th of June. Thank you.